Trace, let's start this conversation, and folks, just type in there if you truly can't hear us. Um, so where are we at? What do you see on the horizon here coming up? We've had a significant um, pullback from where we thought. I mean, we both thought this was going to happen. When it hit 14,000 there for a couple seconds, we both kind of had the opinion that it was a little overzealous. So where do you think we're at now, and kind of like what's your expectation moving forward?
Yeah, I mean, it hit about 13,000. I sold a bunch of 20,000 calls. They expired worthless in August and September. So, I mean, this game isn't really that hard, I don't think. I have other calls that expire on the 25th of October. If you look at the monthly returns, you look at the cycles, you look at the days to halvening, you look at the stock to flow, all that stuff. I mean, October, November generally has a pretty good return. Like those 2 months are seasonally like pretty good returns. Makes me wonder if we've got seasonality in here, kind of like how you get seasonality in wheat or gold. Uh, it's curious whether we get seasonality in Bitcoin because of these 4-year halvening cycles and stock to flow and stuff like that. So I think, big picture, I think we're just going to continue this consolidation that's laying the foundation for a big move in 2020, probably post halvening.
So what I wanted to try to do is just go through a couple charts and kind of get your opinion on what you think about some of these things, because we saw the Mayer multiple jump up to 2.4 at when it hit the 14,000 mark, and then in the past, when it hits that level for whatever reason, it seems to hit a lot of resistance and doesn't want to seem to go much higher. And so we've seen the correction on that. And so I just want to show some people some different things that are equivalent to the halving timeline. So I'm going to pull up a chart here. Let's see how well this works. Okay, let's see if that takes into our video feed. Doesn't seem like it's there yet. But anyway, so you're going to see this chart pop up on the screen here shortly. Trace, it hasn't registered. There it goes. So when you're looking at this, can you see the chart pretty well from where you're at, Trace?
Oh yeah, I can see it.
So what I wanted to do is start off, and this is actually the second slide that I wanted to show you. So this is the 2016 halving cycle, and the green line there is when the halving actually took place. What I did is I drew a line directly from that price at the halving point from 2016 down to literally the middle of the bear valley that happened in 2015. And that date is 14 April 2015. And so when you measure how much the price went up from that deepest part of the bear cycle to the halving event, it was 192% growth from that point in time back in the 2016 period of time. This took about 449 days to take place. So what I want to do now is show you kind of like where we're at right now in comparison to that, using the exact same metrics. What I find kind of fascinating about this chart is you can see how much more aggressive the start to this bull market has been. It's been way more aggressive, because here, I'll go back to the previous slide. Look at the price compared to that green line. It's completely underneath of it for almost the entire push higher. This time it's so aggressively above the line. And just so people know that the slope of that line to the halving event is exactly the same from the 2016 halving cycle to this halving cycle. And so it is extremely aggressive. I kind of felt like, and just to let people know how high that was 300% versus the 192% we would expect if we're looking at the 4-year cycle in the same lens as far as percentages. I mean, we are way above that. So I'm kind of curious what your thoughts are on what's causing that to take place.
Yeah, I mean, I think part of it, we just had it looks like a down BART, and then we got an up BART, right?
Yeah,
The famous BART formation that Bitcoin's made. I think part of it also might be related to, man, I mean, it was just, it was so odd, when that price went down to $3,000, well, 3,200. It just did not seem like very natural market mechanics. And so some of that might have to do with the cash settled futures
yeah,
that we had. Some of it might have to do with BitMEX or Bitfinex, Tether, some of these paper Bitcoins out there that failed, like Quadriga CX. Um, but I do agree. It does seem to be a much more aggressive bull market. I remember I did an interview in June of 2016 when Bitcoin was at 600, saying that the next great bull run had started, and that it might go to $3,000, right?
yeah.
And kind of underestimated it a little bit. And so, man, when you look at the infrastructure that we have in place now compared to the infrastructure that we had that previous cycle, I mean, it's just so much more advanced now. One, we have so many more exchanges. We have LedgerX, we have Back, we have, we just, man, we have so much more infrastructure, which means that a lot more capital can come into Bitcoin very quickly. You look at Back, I mean, they were humming along doing like 20 contracts a day or whatever, and they did like 200 a day. I mean, that volume spun up just like that. I mean, I think that they could spin up to 20,000 with no problem, because they had that huge ICE infrastructure behind them and everything. So I think we really underestimate how little percentage wise of the global wealth and capital needs to move into Bitcoin to have these gigantic moves. And so maybe that's what we're seeing with this much more aggressive uh, chart formation than the previous happening is we're just seeing a lot more people that have a lot more conviction on the Bitcoin price getting positioned in advance. Because these Satoshis are going to get very, very scarce. They already are, but they're going to get really scarce.
So the thing that I think is very different from this point in 2019, almost into 2020 than we were back then and 4 years ago was you also didn't have all the macro stuff kind of playing out that you have right now. I mean, that is way different. I think back 4 years ago, you had the finance industry just kind of looking at this and smirking. But now I think you have a lot of people in the finance industry saying, hey, that thing was supposed to die. The tulips were supposed to wither and die, and everyone was supposed to lose their money, and that didn't happen. And now it's 10 years later, and if this truly was a bubble, it would have burst. And now you got giants like Facebook trying to enter the space, and you got, everybody in the world talking about this. And it seems like you're having, I don't know, I think you're having a lot more interest early on than you did before. I'm kind of curious whether this price action, because I always think about the person who's entering this for the very first time. The person who's like, oh my God, I need to buy this right now and I need to throw everything I got at it. And I just don't want them to experience that severe pain in the 3 month, 4 month period of time because they were too overzealous. And to help them understand that some of these moves are somewhat pretty normal, even though they might not feel like it with the volatility. So I'm kind of curious for some of your thoughts on that.
Yeah, well, I mean, I think we should take care of ourselves first. If other people are going to feel some pain, they should have been here earlier. They should have been here sooner. You know what I'm saying?
Yeah.
Like, um, Because I mean, I held through. You look at some of those charts. I held through a lot of that. Um, I mean, that's a very difficult thing to do.
Yeah.
Uh-oh, did the volume cut out on us again?
No, I think we're still.
No, we're good.
It's not
Yes.
great, but it's there.
Yeah. So when we look at these charts, and this is one thing this is one point that I really like about Plan B's stock to flow and all this data is these charts are encapsulating hundreds of millions of individual decisions over a decade, right? Because I mean, yeah, that it is historic price data, but if the fundamentals of Bitcoin have not changed, in other words, if Bitcoin's still going to be around, and if anything, as you mentioned, Bitcoin was supposed to wither and die, and it's still here.
Yeah.
Like if every day that Bitcoin continues to have 100% uptime, it gains more confidence. And so, when we're looking at these charts and we're looking at these hundreds of millions of data points that are teasing out knowledge, because there's asymmetric knowledge throughout the economy. And that's what all of these decisions that go into these charts are showing, is they're showing decisions that people are making based on their knowledge. And so, like, who's got enough knowledge about the future kind of play out of Bitcoin that they're willing to bet at a 300% versus 192% on the previous happening, right?
Yeah.
Like, I mean, that shows that there's somebody or some buddies that are betting with a lot of money on a different outcome at the similar point in the happening cycle that we had last time. So, I find it very interesting, and sure, some people might buy when it's overvalued or expensive. That's what we have a Mayer multiple for. That's what we have a stock to flow ratio to help guide us on a lot of these things. But I think it's a bigger, as long as people have their time preference in check, I think it's a bigger risk not having Bitcoin. I mean, look at how much negative yielding debt we've got, both on the governmental side and on the corporate side. And Greece just auctioned off negative yielding debt. I mean, these people were having bank runs, and the country was supposed to be bankrupt a couple of years ago, and now they're able to borrow money at negative interest. Like, I mean, it's really kind of crazy world that we're in. And so, I think people they're wising up and buying schmuck insurance because there's a lot of that going on.
I mean, you couldn't call it any better than that. It's truly I want to, in fact, let me jump ahead into a couple charts here that for me just completely justifies the quote unquote schmuck insurance. And here it is. It'll populate here for you in a second, Trace, but I pulled up the picture of the Sharpe ratio compared to all these other equities and bonds and gold and other currencies. And so when you're looking at this chart, which I think you can see now.
Right, I can see it now.
I mean, it's just, for anybody in finance, when you look at this thing, I mean, it's just totally ridiculous, this performance.
For real. Like, if you're supposed to be generating alpha to justify your salary instead of just indexing, right? Like, and you're looking at risk reward. I mean, look at the chart speaks for itself. It just so vastly outperforms everything else.
I mean
have 99% cash and 1% Bitcoin.
Yeah.
You can outperform, right? And be highly liquid. Because Bitcoin's highly liquid. So it belongs in the cash portion of the balance sheet, in my opinion. Especially with the infrastructure we have now.
If you're not somebody in finance and you look at this chart, you're like, okay, yeah, it's higher than the other ones. But for people if you took this chart, you printed it off, and you walked into a professional money manager, somebody who manages a lot of money, 100 million bucks or more, and you slap that down on their desk, they would first question that that's even a legitimate chart because they wouldn't believe it.
Why should they? I mean, we've never seen anything like that in history.
No, seriously. I mean, it's not even like it's just like a couple years that it outperformed. That it is above every single thing by a lot.
Yeah, I mean, oh man, someone likes my cup. I'm glad they noticed. It is 22% karat gold, 22 karat gold. So,
all right. So and if I was going to say one more thing about this chart, Trace, is I don't think people understand how important it is that you not only have that high of a Sharpe ratio, but I would argue equally as important as that is the lack of correlation to all these other asset classes. That's the thing and that would be the other chart that I'd love to see if anybody else out there is great at doing the correlation charts. To show Bitcoin's correlation to the S&P 500, show it to the real estate market, show it to the bond market, and then look at those correlations. And I'm telling you that in itself is as equally as important as these Sharpe return, the Sharpe ratio here, because that for investors, and this is a Ray Dalio quote, runs the biggest hedge fund in the entire planet, is when you have the highest Sharpe ratio and you match it with something that's uncorrelated, you literally have the holy grail of investing. And so people you gotta do a little research on how important this is. It's just totally insane as far as
yeah. So let me kind of lay that out a little bit better in terms of the logic. And I've done this over the years. This is the largest wealth transfer in the history of humanity. It's a once in a species opportunity. Triple entry bookkeeping, provably scarce asset. And so what we're talking about and what you're getting at is all of these other asset classes are like storage tanks, right? And then Bitcoin comes on the scene and it's a new storage tank that's uncorrelated to all the other ones and it's completely empty. And so what's been happening over the last decade is we've been getting price discovery and we've been getting a couple atoms at the bottom of this storage tank. And what's going to happen is this storage tank is going to have to fill up and then capital is going to slosh between it and the other storage tanks, like what already happens between all of the storage tanks amongst themselves. Does that make sense?
Absolutely.
And so it's in the process of creating all of this market infrastructure like LedgerX, BAC, the derivative markets, the DCOs, the CEFs, the DCMs, that are going to enable this sloshing between the asset classes that we haven't had in the previous cycle. And guess what? We're in the information age now. Stuff can happen like that. We could wake up tomorrow and Bitcoin could be $1 million a coin. That's how fast this could happen. Will it happen that fast? I think that's highly improbable, but it could. And that's why you have to have some Bitcoin to be hedged against it, just in case it catches on. So, I mean, I think this is a very important point that you brought up on Bitcoin being uncorrelated to all the other assets. And I think that there are a variety of reasons for this. It's not been investable because of the regulatory scene. It's been misunderstood. People don't have the infrastructure to be able to invest in it. The law doesn't support it. Well, guess what? We got 13 bills passed in Wyoming. And now ERISA fiduciaries can invest in Bitcoin with Wyoming custodians.
Yeah.
I mean, all of this type of work has to get done before the large amounts of capital can treat this as an asset class like they treat all the other asset classes, whether it's real estate, bonds, stocks, etc. commodities like gold and oil and whatnot. So, I mean, man, if people don't have any of this, don't have any Bitcoin, it's it's just such a huge question. Like, what were you doing? Were you asleep at the wheel?
Well,
Because we're talking about the wealth transfer is going to come from all of those other assets to the holders of Bitcoin. So, these pension funds and these endowments, like, their wealth is at extreme risk to getting transferred to the holders of Bitcoin. Like, why didn't you have any?
yeah. Well, let's talk fiduciary duty. Your
Exactly.
fiduciary responsibility. Because if you go in and you slap down this chart and you're talking to a professional money manager, how can they possibly argue? I mean, you can name risks, right? You can say, oh well, it's only been in existence for the past 10 years. I guess that could be their argument, but I think that argument is really starting to go away at this point.
Well, what's a reasonably prudent asset manager going to do? It's been around 10 years. LedgerX, you've got a CFTC regulated SEF, DCO, DCM. Like, so you can have an account there. They can custody it for you. You could even generate cash on it if you wanted. You could generate an excess return selling puts. I sold October this month $7,500 puts. They'll probably expire worthless, but I collected an average of $300 of premium for each put that I sold.
Yeah.
So $300 a yield on $7,500 in USD versus like 1% that I'm going to make in the bank. So I mean, when you start weighing the risk returns, especially with the derivative markets, and then look at that Sharpe ratio, like, I mean, what were you doing? Were you asleep at the wheel managing Yale's endowment?
And then you want to talk opportunity cost. So
Oh,
if so if you want to talk about, okay, well, if you're not going to put me in this and you're choosing to put me in a bond fund, right? I mean, it's getting to the point where if you have somebody in a bond fund and it's yielding 2% and your inflation's 1.5%, I mean, it's just total insanity, man. I just can't even understand the logic behind these arguments anymore.
Let's put some numbers to this.
Yeah.
So I was meeting with he was on, I think he's even the chair. Anyways, he was very high up on a management committee for this institution that had 9 figures of assets, $100 billion plus of assets. And he asked me, like, should we buy Bitcoin? And I'm kind of like, I mean, what am I supposed to say? Like, I've been talking about it for 10 years. Like, scoreboard, of course you should buy Bitcoin.
Yeah.
Like, you're managing $100 billion. Like, you can easily come up with $10 million to buy Bitcoin with, right? Well, coincidentally, a week after I met with him, I get this unsolicited email from someone I trust in the industry. They had 100,000 Bitcoin blocked for sale at a 1% discount, and that was November. So it would have been like $4,500 a coin, right? Mm-hmm. And then like three months later, I get another email from the guy. He's got a 500,000 Bitcoin block for sale at a 1% discount. And this was at like $3,500 Bitcoin. So if these two blocks would have been bought, it would have been $2.4 billion.
Yeah.
They would already have a $3 billion unrecognized gain on the position without selling any covered calls on the position to generate yield. If Bitcoin goes to 125,000, it's a $75 billion unrecognized gain. And that's in like 2 years, right? And if it goes to $1 million in 2025, it's a $750 billion unrecognized gain. And all they had at risk would have been $2.4 billion, and that would have been buying it at a 0.55 Mayer multiple.
Yeah.
Like, so statistically, they're buying it at the very best opportunity on that Sharpe ratio chart.
Well, and here's the thing that I don't think people necessarily understand. I think for people that heard you say if you would allocate 1% and the rest of the 99% was in cash, you would outperform the best market, the best line up there on this chart. You would outperform it. And I don't think I think most people would think that you're joking with that comment, but you were actually being serious with the math.
Well, that's what I'm saying. Like $2.4 billion, you get it into something that's highly liquid.
Yeah.
You know, you're buying it at a Mayer multiple 0.55, so statistically, like the chance that it's going to go down is highly unlikely. And then, like, you look at the Sharpe ratio. I mean, you allocate $2.5 billion, which let's say it's 1% of their total assets. You know, like $2.5 billion out of $200 billion, and yet 5 years later, it could be $750 billion based on a highly correlated, co-integrated model.
Yeah.
I mean, like, why didn't you buy this? What, you freaking asleep at the wheel? Like, how did you miss that opportunity? You know, it's really kind of crazy in my opinion.
So I just clicked to bring up the stock to flow co-integrated model that you were referencing for people. I'm pretty sure most of the people that are watching us are familiar with this chart, but that's the thing that I think others, you know, I guess they're playing this now on CNBC and popping these models up on CNBC, and
it's so compelling.
Yeah, I mean, it's when you model it out and you put the math to it, which Plan B obviously did, and Saifedean talked about in his book, and Plan B ran the data through it. I mean, it's totally insane. And the thing that I find really interesting right now is that stock to flow model is predicting a price of around $8,500. I want to say. And I think we're literally trading at that right now is around $8,500.
Yeah, and the Mayer multiples at 8,600.
Yeah, and the Mayer multiple, we're at a 1.0 on that. So yeah, I mean, I think for people that are looking at the price right now, they've seen a significant correction from the summer, but I would make the argument that you're probably within a pretty reasonable price at this point, give or take $1,000 above or below it. And I think if you're not thinking about it in those terms of that wide of a band of where the price could be, I think you need to start realizing that this thing's extremely volatile because you've got something that's at a market cap of, call it, $200 billion, and it has the market cap that could reach trillions upon trillions of dollars. So when you're this early in the phase, if you're not expecting volatility or price swings that are inside of that margin, you're kidding yourself. You're in the wrong. Well, I guess I don't want to say you're in the wrong thing. I would tell you to look at your position size to manage your risk. And, you know, if you're not comfortable with that much volatility, well, adjust your position size so it is 1% or whatever percent you start feeling comfortable.
Well, first, volatility does not necessarily equal risk.
Bingo.
And so when you're looking at this stock to flow chart first there's correlation, right? And so we've got a 99.5% correlation between stock to flow and time and price, which means that, but that it could be a spurious correlation. So that's why we look at co-integration, and co-integration determines whether it's spurious or not. And since it's co-integrated, it's not a spurious correlation because correlation is not causation. So now that we've got a correlated, co-integrated model, and when we're looking at the co-integration, that's going to help us figure out how to manage that volatility. As I talked about in one of the articles, like the street is the total range that the price could go, and the length of the leash, where the dog can walk, but the leash is the co-integration on how far the dog can get one side or the other.
Yeah.
And so if you're a large asset manager, you sell puts on the downside of the leash, and you sell calls on the upside of the leash. right?
Yep.
Like it's really not that complicated.
No.
And your cash is earning like 1% anyways.
Yeah.
Like, so what, like, why don't you generate 30% yield on the cash selling puts? And then if you get put the Bitcoin, turn around and sell calls on it.
Yeah.
You know, and you're, and a result of capital coming into Bitcoin that way is just going to gradually be moving that price up. And like, I don't think people understand, like, the Bitcoin storage tank can expand infinitely.
Yeah.
It's a black hole on the world's balance sheet. It's an equity-based asset that's nobody's liability.
Well, and that's something I think a lot of people don't understand, that comment.
Yeah, I mean, we have hodlers of last resort, not lenders of last resort. So, like, they can create as many dollars or euros or yen as they want to, and all that value can move into Bitcoin.
Yeah.
You know, and that's what's going to happen now that we have this infrastructure like BAC and LedgerX and the derivatives market, is that we can do a carry trade against the fiat currency.
Yeah. Because it's physically settled.
And there's the volatility there at play. So with the volatility, we're able to completely hedge the portfolio in a neutral way, but capture the volatility premium. And as long as that volatility premium is higher than the negative yielding debt that we're borrowing, we can do that all day long and keep funneling capital into Bitcoin that way, into the black hole.
Well, and so I've been saying this quote for a couple weeks now. I think because everyone's going to start, all these central bankers are starting QE again. This is the fact. Like, that's where we're at. And I think that QE is going to continue to prop up the prices of bonds, and it's going to continue to prop up the prices of stocks as long as trust and confidence can remain in the bond market. And I think that we are getting to a razor's edge of that confidence disappearing in the bond market.
Yeah, but when you say it's going to prop up the price, you're looking through the wrong lens. And that's the $1 trillion question, right?
Well, I don't necessarily say that that's my point of view. I'm saying through the collective mind of market participants right now, I would describe it as that.
Well, yeah. Well, they'll prop up the price in terms of dollars.
Exactly. Yes.
Yen,
yeah.
But and with the gold price depression, they may even be able to prop up the price in terms of gold. Although they haven't been very successful over the last decade of being able to do that, even though they've thrown a lot at it. You know, look at Berkshire Hathaway priced in gold or the Dow priced in gold. But what they're not going to be able to do is they're not going to be able to prop up the price relative to Bitcoin.
Well, of course.
Because there's only one way for the Bitcoin price to go relative to all of the other assets in that liquidity pyramid. Yeah. And that's up a lot. The exchange ratio between Bitcoin and all these other assets. And that's the wealth transfer. And that's why all these other assets are at such great risk of losing their value relative to Bitcoin. You know, they're okay, sure, you can have your price high in Weimar marks, but that doesn't mean it's going to actually be able to buy anything.
So I just pulled up a new chart for you to look at, Trace. You can see here we've got the and when people are trying to understand why we're going to see the price continue to plow into the soundest form of money, I would argue that the next couple charts that I've got here are going to be the reasons why. So you can clearly see on this chart, this is the balance sheets of the major central banks in the world. You can see that there was a major event there in the middle of 2008 going into 2009. And it's only accelerated ever since. So when you hear all of us saying QE and quantitative easing this and that, what we're really talking about is what's being represented on this chart. And I have a couple more here that kind of go into a little bit more of the specifics, and I'll wait for them below here for Trace to see it because he's looking at the live feed for the load, and it's a little bit delayed. But the next chart that's populating right now is each one of those major central banks broken out. you have the ECB, you have the Fed, you have the Bank of Japan, you have the People's Bank of China. You can see each one of those represented on the line, and what you can see is a coordinated effort amongst a lot of these central banks that when one is easing, the other is holding tight or slowing down their easing operation, so that collectively on a global scale, what you have happening is this just continual straight line growth of fiat currency. So now as the next chart populates, what it's going to do is it's going to sum and it's going to add all those central bank balance sheets together. And you can see it coming up here on the screen here in a second. It's quite impressive how linear and how coordinated that looks whenever you combine all of them together since the 2008 timeframe. Now, what you can see is at the start of 2018 or 2018, you had central bankers collectively trying to ease, trying to tighten. And what was fascinating is you can see they really didn't tighten all that much. If anything, they just kind of plateaued. And I would argue that that even though they were just plateauing their balance sheets, they literally hit a physical limit on, and I've got a chart here and a couple more slides where the repo market was basically the physical limit that it hit. It was like the backstop saying, you're about to have a meltdown if somebody doesn't step in and start adding liquidity into this freaking system, because this is getting ugly. This chart that just populated right now, you can see is a chart that shows the S&P 500's performance relative to the expansion of the balance sheet, and you can kind of see that there's some correlation there. Whether there's causation, I don't know. We'd have to get Plan B to do some covariance models on this to see whether that's legit or not. But just kind of interesting, just looking at it and seeing the correlation. And let me show you the last one here with the backstop. So this is just the Fed's balance sheet that I pulled up. And Trace, you're going to see it here in a second, but you can see the Fed balance sheet and how much since the beginning of 2018 we have been trying, in the U.S. has been trying to tighten their balance sheet, and within literally a matter of weeks, we've already basically had to put 25% of that tightening back into the. Now, some would argue that that's not officially in there yet because it's in the overnight repo market, but the way the repo market's going is it's only adding more and more to that number opposed to just a 1 day or a 1 week kind of thing. And then just, what was it, 2 days ago, we had the Fed announce that they're going to start doing, they're not calling it QE, but they're basically buying back the shorter end of the bond yield curve with, I'll call it QE. So it's getting quite fascinating to see how the very little amount of tightening they were able to do, and we're already hitting the backstop, which means I can only imagine what this is going to look like as they go QE round 2 collectively on a global scale. Like we're at the tippy top of the stock market globally after 10 years of growth, and every central bank at this point is now saying they're going to do more QE.
Yeah, I mean, it's going to be QE forever. They're just, they have to do that because what they've done is they've created this fractional reserve, huge credit expansion in the liquidity pyramid, and they don't have the liquidity there for the demand deposits, for to make payroll, for all this type of stuff. And so, and this is not just the Fed, but these are all the central banks, because everybody's playing the same game with fiat currency and fractional reserve banking and rehypothecation and all of this stuff. And so, they of course they're going to step in and keep the system from collapsing when, and I don't know who it was. Was it ICD, one of the Chinese banks, or was it Deutsche Bank? Like, who needed that repo money? right, from the Fed. Like, I sure like to know who needed it so I can short their stock and not lend any money to them in the overnight market. That's what I would want to know. And so what we're kind of, what this is highlighting is, and what I think people just underestimate again with Bitcoin is Bitcoin is becoming this ultimate form of collateral. Because you can't confiscate it through inflation. You can't just print more of it. It's, scarce, and it's equity. It's nobody's liability. That's why proof of keys is so dangerous to people who are playing games like what the Fed is playing. The type of regulation that Bitcoin imposes on the world, where people demand possession of it with their own full nodes and their own private keys, you don't get to play games like this.
Yeah.
Because when stuff like this happens, that bank is dead. It's dead because you can't get it liquidity. And if there's anything that we learn on why businesses fail, it's because of cash flow.
Yeah.
It's not necessarily because they have a bad business model. It's not even necessarily that they're bad operators. It's that they don't manage their cash flow. And so, sitting on a nice big hodl stack of Bitcoin, guess what? You have a lot of liquidity. And then in the derivatives market, you can sell volatility. So you can sell covered calls and generate short-term spending money or whatever that you might want.
Yeah.
Or generate an even larger hodl stack by selling a covered call, selling a put with the proceeds, and accumulating more Bitcoin that way. And if that's how this is going to play out, where retained earnings are getting held in Bitcoin, not in treasuries, where CFOs are hedging the cash portions of their balance sheet that way, the rate at which wealth can compound into Bitcoin is going to be huge.
Oh, yeah.
Effectively, anybody who holds Bitcoin is going to hold a future claim on the productivity of the planet in perpetuity, discounted to the present. That's what the price of Bitcoin is really showing us. Because, if it becomes this ultimate form of collateral, because it's the safest and the most liquid asset, the hardest money ever invented, it's huge. It's just absolutely huge. And I think more and more people, it's the light bulb's going on for them.
Yeah. So I just clicked on another chart. You'll see it here populate in a second. And what this chart is this is the long-term bond buying to quote unquote manufacture growth. You can see how the yield in the bond market has been going down since 1981. This chart only shows on the left out to 1987, but if it went clear out to 1981, you'd see how the yields in the bond market have continually just been going down. The Fed, this is just for the U.S. Fed, has been adjusting that federal funds rate in order to control this. Once we got into 2008, 2009, they couldn't drop rates low enough, so that then they had to go and start implementing this QE strategy where they're buying bonds off the open market. And what people need to also understand is that as this yield is going lower, the price to that is inverted. So the price is going higher and higher and higher. So you typically see bond charts that are just based on the yield, but if you could see a bond chart that was based on price, you'd see the price is just getting bid and bid and bid and bid. For 30 years, the price has been bid. And so now you're at a point where you can't bid the price once it starts bottoming out at zero. Once you bid it so there's literally no yield left, and this is in the U.S. where we still have minuscule yield left on some of our bonds, and I have a chart that's coming up that shows the bond prices across the globe. Once it starts going negative, like you're literally signing up for a contract to lose money. It'd be like me going to Trace and saying, hey bud, I want you to sign this contract, and the contract says you give me $100 today, and then I'll give you $90 back next year. Just sign right here. That's all you got to do. It's simple, you're guaranteed to lose money. These people are literally signing contracts to lose money in the hope that they can go out and find a fool that's dumber than they are that will buy that contract at a premium, okay, so that they can get their $90 back. So the idea is I sold it to Trace for $100, but Trace now is going to try to go sell it to somebody else for $110, but they're still getting the $90 back from me at the end of the contract.
Yeah, I mean, if you've ever, delved into like advanced financial management and how you price bonds with premiums and discounts, effectively, it looks like we got a bunch of these high frequency trading firms that are just trading bonds around with each other, and they're willing to trade because now you've thrown a monkey wrench into the whole equation with these negative yields. And who's going to be stuck, with magical chairs, right? Like there's not going to be a chair. And the longer we keep doing this, like the longer it's going to keep getting worse and worse. Sparkling water out of my gold cup. Someone was asking what I was drinking. And yeah, so I mean, this is a huge problem because manipulating the interest rates in this type of a way does not manufacture growth. In fact, it innervates the economy. It doesn't excite it. It fundamentally hollows it out and makes it weaker than it otherwise would be. And you look at that chart and you look at the standard of living of the average American, for example. When that chart started, my dad, well, actually, 20 years before that, my dad, his first job out of college, he earned 25.7 ounces of gold. That's $500,000 a year.
Yeah.
That's the type of purchasing power that a brand new college graduate was getting. And now they get a pittance of that. That's what's happened in terms of standard of living.
Yeah.
Because all the advancements from technology and spreadsheets and internet and email and robotics and AI and all this stuff, it's accrued not to the benefit of the average person, but to the benefit of people holding bonds.
Yeah.
And so, something's going to have to give. I think it's going to end up being fiat currencies. Probably what's going to have to give. And, that's one of the great things about Bitcoin is that if people haven't bought it, they have no one to blame but themselves. It's been a totally peaceful, voluntary choice for a new change in terms of the monetary system.
I think you and I have an interest in this stuff, but the typical person, they don't have an interest in it. And I think the next thing that your typical person who just their thoughts are not consumed by financial markets. They're just not. They're focused on other things.
Well, yeah, but if you want to watch the Kardashians, like,
well, I'm with you there.
While the wealth transfer happens, and that's how you've chosen to allocate your human capital.
Yeah, no.
You've chosen the dollar cost average into a cable bill instead of into Bitcoin. No, for real. Like, their choices have consequences.
That's and for sure.
Bitcoin's going to be brutal at allocating the choices and the consequences. You make the choices, Bitcoin's going to brutally allocate the consequences. And I think a lot of people, whether it's with the professions that they've chosen or the education that they've gotten or, the hobbies that they've enjoyed or decided to allocate their capital to or the way they've kept care of themselves and their health and all of this stuff, you're not going to be getting bailed out anymore. Because the governments are going to default on all these promises that they've made. All these European countries that have healthcare systems and stuff, they're going to have to default on those promises. All these pensions, all of this stuff, Bitcoin, the wealth's going to get transferred. That's what we're talking about.
So
negative yielding rates, more craziness.
I mean, this chart here is another one that just, I don't even have words when I look at this.
30 years. Look at that, 30 years out.
I know, 30 years out. You're in the negative territory for Swiss 30 years.
I mean, you got negative interest rate mortgages in Denmark now.
Yeah. And so for me, when I'm looking at this and everyone's like, well, like, what's the timing of all this bond market's going to blow up, the stock market's going to blow up, and all that? And I just look at people, I'm like, it really kind of depends on this chart collectively. And you can see how the line of red is working its way further and further down so that every country has negative yielding debt. And for me, at that point, there's no doubt about it. There's no way that that's sustainable at that point, because then everyone's like, the question then becomes, how is that possible, and what is causing this? And then it's a direct turn from the bond market to fiat currency, right? At that point, that's the only way that anyone can describe why this is happening, is because central banks are bidding the price of bonds into oblivion at any cost. They're a buyer at any price at that point. And so collectively across the entire globe. And so how much longer can this go? I don't know. But I tell you this, I don't think it's going to take the whole chart to turn red to get there. But I do think that we're getting a whole lot closer. And the speed seems to be accelerating, right?
Yeah, well, I mean, the faster it goes with this type of stuff. But yeah, I mean, what's gonna like shake people out of their comatose state watching the Kardashians? You know, is it gonna be GE's pension blow up that just happened?
Yeah.
Like, oh, let's just cut all your benefits. Oh, now you can't afford your Kardashian TV show anymore, or whatever. Yeah, I mean, what's going to actually, like, rattle people's cage enough that they're going to start taking action and deciding, you know what, maybe I'm going to buy some magic internet money. I mean, I thought it would have happened by now, you know, but maybe it is happening. Maybe it's just going to be a slow burn for, 10 or 20 years, like the charts, showing us these negative yields out 30 years. I mean, 15 years for 3 of the countries. It's just wild.
I mean, you could make the argument that the fact that it is taking longer than what I would suspect it would have taken has been very beneficial to Bitcoin because of the infrastructure and the entrenchment that's been able to occur throughout this long period of time.
Yeah, and another thing to keep in mind is that, individuals, we kind of live in terms of months and years, whereas or even days and months, whereas governments live in terms of years and decades.
Yeah.
So, we're just on different time frames. And, a lot of people, they just go about their business, they're not really concerned about these things. But then of course they wake up when their pensions get cut and start squawking like, stuck ducks or whatever. But by that time, they're getting turned into soup anyways.
So, okay, let me pull up another slide here. This next one that I have pulled up right now, you'll see it here in a sec, Trace, is one that I took off of your website that shows the pyramid of money, where you got the derivatives on the top, 1,600 trillion.
Yeah, and this is 10 years old, and that previous chart on the negative yielding debt, that shows exactly what was predicted with this liquidity pyramid.
Yeah.
So,
yeah, I'm kind of curious. So when you're looking at this, and your gold and silver price that you have in there is 2 to 4 trillion. I think some people now are stating that that's more around 6 to 8 trillion. But you look at all those other asset classes, and you realize that those are heavily reliant on a credit-based monetary system that, I mean, I don't know how much, if you were going to say monetary baseline, like real dollars collectively on a global scale, you got monetary baseline money, and then you have credit. I don't know what that percent between those two would be. They both spend the same as if they're, they're quote unquote money, but one will last through a liquidity crisis where the other one contracts in an extreme way. So I'm kind of curious how you would describe what these numbers would look like if that quote unquote money that's credit based, that can contract in an extreme manner during times of liquidity crisis, what would these numbers look like? I don't even know how to start to quantify that. I just know that it's going to produce some really interesting results.
Well, yeah, I mean, the quote up at the top, the system does not collapse but evaporate. So first, we're going to have a bunch of evaporation as the real capital furrows down the pyramid into the safer, more liquid assets. And I published the book the same week that Bitcoin got released by Satoshi. So really, it should say like Bitcoin, gold, and silver down there in power money. And that's because those are equity based; they're no one's liability.
Yep.
And so as the stuff evaporates in this pyramid, the liquidity and the value evaporates. That's a form of deflation. And gold is actually a deflation hedge, not necessarily an inflation hedge. And so what's happening with these negative yields is everything's moving down into like the yellow and the green bands, and capital's burrowing in there because those are perceived as safe and are very liquid currently. But those bids can stop in an instant, because, and then we get hyperinflation, which is actually a form of deflation. Hyperinflation is evaporation of that layer in the liquidity pyramid. And that would happen as the capital moves into the gold, the silver, the real assets, and things like Bitcoin. And that's why I'm saying, like, it could happen like that. It could happen. We could wake up tomorrow. That's how fast it could happen in the digital age, because these Bitcoin exchanges, they trade 24/7. Yeah. Right? Like, so, I mean, yeah, I mean, I sleep very soundly at night because, I'm in the lifeboat. And you got to take care of yourself first. So, make sure that you get yourself in the lifeboat, and then, if other people want to stay in the burning building in order to make an extra buck, like, that's their prerogative. But, somebody has to take the loss. And the loss is going to be not just a change in the numbers of those assets, because you're like, what would the change in those numbers be? But it's a change in the denomination. Like, that's not a dollar sign anymore.
Yeah.
If this really plays out that way, the destruction of the dollar and the fiat currency system as we know it worldwide.
How do you see the derivatives number? I mean, because it's so massive on here, and it's so dependent on all of this credit expansion that currently exists in the market. So I'm kind of curious how something like that would play out as that numeraire kind of shifts from all these fiats that you have in the world to something like Bitcoin taking a much major role.
Well, that's what those derivatives mainly are managing, right? Yeah. They're interest rate derivatives.
Yeah.
Because those are the common stocks of nations. So I mean, yeah, you've got Exxon Mobil's and Apple's, but those are small compared to like Germany's and France's and the United States. And that's what we're talking about is like the ocean of capital, which are the currencies. Those are what we're having trouble with, and then those currencies are infecting all the balance sheets of the institutions that are out there. The Exxons and the Apples. But yeah, I mean, the question is like, when this infrastructure that is now built, and CFOs of Exxon and CFOs of Apple, can start hedging themselves against this type of risk with Bitcoin on the balance sheet now. Yeah, I mean, sure, we might have a lot of evaporation of the banks. I could see a lot of them failing, but they're just getting bailed out by the central banks. But the purchasing power of the currency is what will go down. But the actual institutions themselves, the Apples of the world, the Cargill, I mean, people still have to eat, and humanity is going to find a way. Life finds a way, right? From Jurassic Park. So Bitcoin can act as that release valve for a lot of this chaos, which we didn't have in 2008. We have it now. So in terms of it posing a grave risk to like the social cohesion and social stability of the nations, well, then that becomes like, how draconian are you going to be on your Bitcoin related activity?
Yeah.
Are you going to be like China and India, or are you going to be like the U.S.? Because like if it happened right now, the U.S. would be the prime benefactor to a shift to Bitcoin as the Bitcoin standard, and it would probably cement American hegemony for centuries. Because I mean, our institutions, our businesses and corporations, they perform economic calculation a lot better than a lot of the other companies and organizations that are out there. I mean, look at all of China's state-owned enterprises. Like, how do they perform economic calculation? I mean, they perform political calculation. Not that like U.S. companies don't perform political calculation. They do, but they do it to a lesser degree than the ones in places like China. And so as a result, the U.S. economy is going to be much more flexible and adaptive to these types of shocks. And that's we're talking about a whole flock of black swans that are coming in all at the same time. Because this is an economic, a financial, a monetary, a political, a geopolitical crisis that's all, coming in as like a category 7 hurricane.
Yeah. The one thing that I think is going to help, going back to the Sharpe ratio and kind of institutional investors and the rest of participants in these markets to start doing 1% allocation to Bitcoin. I'm sorry, a lot of them are not going to go to open an account, conduct the purchase, store them locally, at least not initially. So I really think the ETF approval here in the US is going to be massive for price acceleration in this next bull market. So I've heard Monday there's going to be an SEC decision on whether one of the ETFs gets approved. Have you heard anything more on that and what you think the likelihood of something like that going through is?
Well, I mean, there was news today about Bitwise as ETF that got denied. And the main issue seems to be the SEC wants there to not be manipulation on exchanges for Bitcoin. The Bitfinexes or the BitMEXes, these unregulated venues, as opposed to places like Bakkt or LedgerX. So I think that might be the next area of territory that's going to be getting taken. Is I think you're going to see the attacks on the Bitfinexes and the BitMEXes and companies like that get ramped up. And we're seeing that with
from the owners of things like Bakkt and these other exchanges.
Yeah. I mean, that's the fight that's shaping up, right? Like sticking the New York DFS on Bitfinex, for example. So I do, I think that, and we saw that with online poker. I mean, it's not anything that's particularly surprising to see happen. But yeah, I mean, there does. I mean, we've got the tools out there now with Bakkt and LedgerX, but an ETF would be helpful, for a lot of these fund managers. But they're sophisticated enough that they could use the regulated solutions that are currently out there if they wanted to.
Yeah. Well, I'm just thinking of it in terms of like my parents' generation. They want to sit there at their Scottrade account, or now it's TD Ameritrade account, and they want to be able to log in there. They want to be able to look at it like it's an ETF, like the S&P 500, and they want to be able to just buy it at $10, right? And if they want to allocate 1% to it, that's how they want to do it. Just they don't want to have to think about any of this other stuff. And I think the fact that you've had this much movement on this thing, I think if you started seeing this thing go over 20,000, which I think by summer time frame you should be seeing those numbers, right?
Oh yeah, it's going to be fun.
That's where you're going to have, I think, those people that participate in financial markets. They're going to say, all right, there's something to this. There's something going on. What the heck? I'll throw whatever 1% at it, 0.5% at it, or whatever, and then you're going to have people that see 100% gain on that small position, and then they're going to say, hey, well, I just throw a little bit more. I'm so far ahead in the position. Let me throw a little bit more at it, right? And if it comes back down to my principal of both of those entry points, well, then I'll sell it. But then it's going to keep running on them, right? So that's where I think this next bull market is going to really kind of.
Well, this is all infrastructure, right? BAC, LedgerX, ETF. It's all infrastructure that makes it easier to move capital into Bitcoin. Some people I saw someone complaining about Kraken like listing all these altcoins. And it's like, no, you want to have markets like list as many things as possible that people can trade to buy Bitcoin with.
Yeah.
The more like pipelines we have of capital that go into Bitcoin in terms the infrastructure built, the better, in my opinion. Another point to kind of be raised. You mentioned your parents' generation. I don't think we should underestimate the degree of demographic war that is taking place right now. Also, because it's your parents' generation, they're the ones that have all these bonds.
Absolutely.
Right? They're the and then the younger generation, they've got a bunch of student debt and they can't buy houses.
And Trace, which generation thumbs their nose at the quote unquote millennials because they're still living with their parents, but yet during their generation, they were going through massive money multiplier expansion, right? And we could get into a whole long conversation about what that is and what that means. But for them to go out and buy a house when they were 30 years old was not anything but, that was commonplace across their generation.
Oh, yeah. Well,
right?
That's what I mentioned with my dad.
Yeah.
His first job out of college, $500,000 a year.
Yeah.
In today's purchasing power.
Yeah.
25.7 ounces of gold per month.
Yeah.
So, when they want to make any type of comparisons across generations.
Oh, I know.
I don't. Well, let's start measuring with things that are comparable. That's one of our first rules in accounting. We need comparable financial statements. And so let's measure things in gold because a gold, 40 years ago or 30 years ago is a gold ounce today too. And so that gives us comparability. And so, this demographic war, that's playing out in terms of, and it's now playing out at the ballot box, in countries that have elections. And it's playing out in riots in countries that don't, like Hong Kong and Venezuela and other places. This is all part of the fourth turning. This is all part of generational cycle. It's Bitcoin is anti-fragile. It's built for this.
Well,
this is the environment it thrives in.
Isn't it amazing how the universe finds a way to balance? So
life finds a way.
It finds a way to balance, and so you look at this younger generation. Who's going to be the first people to jump on this bandwagon, both feet first into the water? It's going to be this younger generation, and they're going to throw whatever they can afford, call it $500 at this thing, and you're going to have a lot of boomers that are going to be holding on to their bonds. And it's going to be total obliteration in that market.
Yeah, and I saw a tweet earlier this morning, like some guy he was talking about how he had over $1 million worth of Bitcoin like back in 2015, but he wouldn't sell any to buy a car, and he rode around in Vegas in the summer on his moped.
Yeah.
Guess what? I still drive a 2000 Toyota 4Runner with less than a $3,000 Blue Book.
Yeah.
I got a friend, when Bitcoin was like $12, he sold a bunch to buy a Porsche Cayenne.
Yep.
Whoops. Like time preference, whoops, opportunity cost. And I like my 4Runner, to be honest. I like driving it, even though I could afford Cayenne, and I think I would like a Cayenne, but this 4Runner gets me from point A to point B. And that's what we learned in the Great Depression from that generation, which is the comparable generation to the millennials. It's you use it up, you wear it out, you make it do, or you do without.
Yeah.
Time preference and frugality and thriftiness, and those things aren't very much in vogue. But guess what? Bitcoin is teaching those lessons. Bitcoin is a great educator on things like time preference and opportunity cost.
Yeah. Hey, so I think that there's a question here that I want to take because I think there's probably a lot of people that are wondering this, and I think it's so important for them to hear how you respond to this. So this person wrote, please, I need an urgent answer. What is likely to happen to BTC soon, pump or dump?
I mean, now with the derivative markets, I mean, I look at the Bitcoin price in 3 month increments, more or less, like totally. 2 to 3 month increments.
Yeah.
Because I'm selling volatility.
Yep.
Right? Because I have the ultimate collateral. So, and I'm looking at the Mayer multiple and 200-day moving averages to filter out all the daily noise. So, I mean, I've just shifted my perspective. I sometimes I go like a week without even looking at the Bitcoin price.
Yeah.
I don't even look at it.
Yeah.
So, I mean,
well, in the grand scheme of things, and people got to understand, if you're buying Bitcoin when it was $1, right, or $2 or whatever it is, and now you're seeing the price at 8,500 and it goes to 8,600. So I think what people don't realize is, so they just got into it, and those price swings for them are enormous. They're not used to seeing something like that, but you got to realize it's just the nature of the beast. It's volatile. It's a long time. It's a time preference kind of thing, and if you plan on owning it for another 4 or 5, 10 years, well, you're going to see the performance over that period of time. I wouldn't get caught up in the week to week.
Well, and also if you're a hodler of last resort and you're playing this right, then you can effectively sell volatility, right?
Yeah.
And I have thousands of dollars a day of volatility that evaporates because I've sold I have $50,000 December calls that I've sold.
Yeah.
And $25,000 calls and $15,000 calls, and I have $15,000 October calls that are going to expire on the 25th. And so if you're the hodler of last resort, you can harness those to start generating cash flow for you. I mean, thousands and tens of thousands of dollars a day. There's that much volume in the derivatives market.
Yeah.
So, and that's only going to pick up as we get more sophistication in here.
Yeah.
So, that's, I think people should be looking at, trying to figure out how they can harness their Bitcoin in that type of a way.
Yeah.
Instead of looking at like day trading or like doing, and checking the price all the time, because then the Bitcoin price is controlling you.
Absolutely.
I like to make technology my servant, not my master.
Yep.
And so, Bitcoin is my servant. I don't let it control me, and I don't let it control my thoughts either. I'm interested in it, and I really love it, and I have a bunch of passion for it, but I have a lot of passion for other stuff too. And so when I want to take my attention and direct it on the other stuff, I can do that. I can do that for a week at a time and not even check the Bitcoin price.
Yeah.
And so, I think, when we're looking at like this very short term, way of looking at Bitcoin, it's a very easy way to get yourself distracted from the real game with it, and I think a lot of that game is being able to take advantage of selling the volatility. Because, you take things like the Mayer multiple and the stock to flow ratio, and next thing you know, you're able to make great trades. For example, December of 2018, I actually tweeted this out. I tweeted the screen capture of this trade out where I bought the 5K calls.
Yeah.
Right? Bitcoin was $4,000. I bought 5K June 2020 calls for like $1,100 a piece.
Buy them out of the money, lever them up a little more.
18 months out, I'm paying $6,100 a Bitcoin. 18 months out, when the Mayer multiple's at 0.55.
Yeah.
You do that trade on 77 Bitcoin, and then you like go you go hike it in the mountains or something.
Well, and the thing is you're looking at the 10-year trading on the daily trading on that, and the Mayer multiple hit those levels like 6 days out of the last 10 years when you put that position on. So you're at a 2.5 standard deviation event, and you probably went hiking with quite a bit of confidence.
Oh yeah, I mean, like statistically, like I have a very high degree of confidence that Bitcoin is going to be higher after the halvening than it is like 17 months before the halvening, because I've been through 2 of those halvenings now. And then now with Plan B stuff, I can write I can write the derivatives, either buy or sell the derivatives with a whole lot more confidence now. And then another thing that's fun is that you can, with LedgerX, you can use those 5K calls as collateral to net. So instead of having to lock up a whole Bitcoin, you can lock up that call and then sell like a 25K call or something. And so you can progressively lever up that position. And I haven't done any of that yet, but I will, when the price is up high enough. But I mean, that trades up like 3.7x in Bitcoin or something like that.
Yeah. Oh yeah.
Which is great.
I can only imagine, and yeah, you think the Bitcoin price goes crazy. You just start trading some call options, especially if you purchase them out of the money. I couldn't imagine what the principal looks like, or what the growth on the principal looks like. It just has to be astronomical.
Well, I mean, if we're looking at $55,000 Bitcoin in June, then I paid $1,100, and the things are going to be worth about they're going to be worth 55x. Kaboom!
I love it. Hey, so I want to talk to you about it was interesting. Pomp recently had an interview. I hadn't listened to it yet, with the CEO of Ripple or XRP or whatever we're calling them these days. And before he had this discussion, he says, what's your question you'd like to ask them? And I had made the statement that I'd like to ask them about what it feels like to not have a halving cycle, or having a block reward halving as part of their protocol. What does that feel like? And it was funny because I got a lot of responses back from the Ripple army, basically saying, well, our currency is already deflationary. Basically, every transaction they're burning coins on every transaction, even though their quote unquote non-profit keeps adding coins onto the.
It's a giant pre-mine.
Yeah, massive pre-mine. And so what's interesting about this is, because their big argument now is that they're completely decentralized. That's their argument, and I want you to shoot holes through that. But that's their argument, is that they're completely decentralized from their quote unquote nonprofit organization that just acts as a proponent of their protocol, right? But I think the thing that people aren't going to realize is, because people would see that argument and say, well, one's literally deflationary today, and the other one we're still adding coins to the mix. So I'm kind of curious to capture some of your thoughts on that. And then I have a comment that I want to add in there that I think really separates the two in a major and distinct way. But I want to hear your comments first.
Yeah, I mean, I don't spend much time and attention on Ripple just because I don't see it as a very serious project. But you're also looking at the float, and so they contributed a lot of money to a market maker that helps manage that price, and so they're selling. They lock it. They get that XRP that they take out and start selling it into the market in order to basically suck out all the value of the new people coming in. New people putting money into it.
Yep.
And as far as it being decentralized or anything like that, I think that's a total fail of an argument. And actually I think it's a security. And so, I don't know where the SEC is. Maybe they got their $24 million, kind of like with EOS, but,
Well, they're claiming that they discovered it, Trace.
Yeah, I know. It's like, yeah, sure you did. Like, I mean, that's what you're dealing with a lot of these people. I mean, just shady altcoin promoters that are engaged in half truths and they're just not being straight up. Like,
well, even so, let's just do like a thought experiment here. So let's just say that it is decentralized. Okay, let's just play that game. And so if they are in fact burning coins on every transaction, and let's also assume that this Ripple nonprofit, I don't know what in the world you would call it, that's sitting on this massive treasury of their XRP is dropping these into the protocol. Let's just say that they're not going to do that and they're just going to continue to hodl their position. Then you actually have a deflationary currency. But I think that where this really comes off the tracks is you don't have participants of that coin that are incentivized to bid the price higher. Okay. Where in Bitcoin you are because you have miners that are performing work. They're burning electricity. They're spending money on mining rigs that what it used to cost them, it'd almost be like you own a mine and I own a mine and we're mining gold, right? And the stock to flow on that's whatever. And we wake up tomorrow and there's an announcement made that now it's going to cost us twice as much to mine the same amount of gold that we did the day before. Because that's effectively what's happening with Bitcoin. So now you have miners that are going to demand a higher price for those coins that they're mining. Okay? And so when they want to trade those coins, those scarce coins that they're mining and put them back on the open market, they are going to demand a higher price. So my argument is this: the fact that that happens in a 4-year chunk, the fact that it's not happening in this linear, smooth way, in my opinion, is the current protocol by doing it every 4 years is very advantageous to the price movement of Bitcoin because it forces these miners to make these economic calculations that are much more unpredictable than if they were linear. And so what I think it does is it ratchets up the price in this abrupt manner that creates this flurry of activity and this marketing and branding effect because you're dealing with a small unit of whole number coins that are out there. There's only 21 million coins out there, right? So when that price is going up in these very substantial ways relative to fiat currency that's noticeable and gets headlines, you can't pay for that kind of marketing. Like this is something, it's a freaking feeding frenzy that they're not going to be able to replicate with their protocol, in my opinion.
Yeah, I mean, I think Satoshi was very deliberate in the emission schedule of Bitcoin, in its monetary policy, doing it in kind of this round A, round B, round C type of a way. Also, at the first Satoshi roundtable, I was asked to give kind of the introductory welcome talk by Bruce, and it was in the bottom of the bear market in 2014, and I told everybody, I was like, look to your right, look to your left. These are the people that you can do business with because they're here in the bottom of the bear market. And, every time the price starts going up, we get a whole bunch of hot money that comes chasing and wanting your time and wanting your attention. And we get all these new people and stuff like that. Well, if you were here earlier, that's also a form of human capital. The Krakens, the Coinbases, like that brand recognition, that length of stability in the ecosystem still being around, as long as you don't torch your reputation like BitPay's done, that becomes a very valuable asset, that you have, that you were around in the bear markets and you survived them and everything. And so I think Satoshi was very deliberate in the monetary policy of Bitcoin, in this emission schedule, so that it could bring these different ways of adoption, because it also helps the ecosystem build out. And when stuff goes all crazy and then we have a correction in the price and stuff calms down, well, all these companies, they get to work on building their systems out for another couple of years.
Yeah.
Right? and then they get ready for the next cycle. So, I think all of this was very good. And, what you're also hitting on just the news and all the effects that has. That's great for the first network effect of speculation. Getting all that news and having all that crazy price action and having, getting that supply shock because the transactional demand and the price elasticity of the transactional demand doesn't really care about the price. And so, when you get these big influxes of new users and it being a Giffen good and a Veblen good, like, you get these huge overshoots in the price and everybody has a hard time managing their emotions and whatnot. And previously, we haven't really had the infrastructure to be able to take gains off the table very easily. Also, you might be afraid that your bank is going to close your account when you receive a $50 million wire, right? And so, you just kind of hodl through. So, these are all things that I think Satoshi intentionally put into the protocol for a lot of these reasons that you outlined, and I think that there's some other reasons too that he put them in there. Because it's going to take time to develop the tech and the extensibility of Bitcoin. Things like Lightning Network and Schnorr signatures and the other software, like all of this stuff, because Schnorr signatures were around, they were just patented. That's why Satoshi didn't put them in there. But the patents now run out, so we can put Schnorr signatures in. So, there's stuff like that in terms of the technical development that I think also plays in with this 4-year cycle.
I think his greatest strength that isn't talked about nearly as much as some of the other things is just his understanding of game theory. And I'm saying his, I guess that's a bias, but the fact that there's so much game theory wrapped into this that I don't even think people fully understand the implications of how much game theory is wrapped into this.
Oh yeah, there's a ton of it, and you have to understand the proper economics. You have to understand the Austrian school of economics, yes, which alone is a very misunderstood or not even comprehended area, and even people that think that they understand it, like Peter Schiff or Roger Ver, they're just water skiers. They don't have any scuba diving equipment to get deep into it. Yeah. And you have to get deep into it in order to really appreciate some of the genius of what Satoshi has done in all of this.
Hey, so I put this chart up on the screen. This is the histogram of the Mayer multiple. So right now you can see we're at a 1.0 on the Mayer multiple, which would imply, based on this chart, that it's reasonably priced. It's where you can see where most days in the last 10 years have fallen, and we're right there. I will say this: the average, if you were going to look at this from an average standpoint, the average is actually 1.4, which is quite a bit higher than where we're at right now. So I forget what percentage of days it's higher than 1.4, but I think the price is only lower about 30% of the time. The price is lower, even though this chart would make it look like it's about a 50%. The price only goes lower than where we're at right now about 30% of the time, 30 to 40% of the time. So I think
that's because it's a bull market.
Yeah.
All the time for Bitcoin, right?
You're right about that. You're right about that. I have a kind of a fun chart that I'm going to bring up right now. I don't think that this carries a whole lot of weight because it's very short-term thinking, but I think it's fun to talk about. It's kind of neat to look at. So what I have up right now is a chart that I have titled Fractals, and what I have is on the top of the chart is the 2018 bear cycle. And what you can see on this chart is how much percent change from the top. And then you had what a lot of people call the minor capitulation there at the end, where it went from whatever price that was at that point to a little bit over, it looks like it's a little bit over 6,000. And you had another 50% drop from that price. And then you have the number of days that lasted. And what I found really interesting, and I'm not suggesting anyone makes any entry point decisions or anything based on this chart, but I found this quite interesting that this recent mini bull market that we had seen this year in the summer, when the price hit 14,000, it had a 30% drop, and then it was 89 days in length. And so using the fractal from above and then looking at the one below there, I'm just doing a little math and looking at some ratios to see maybe we might see something similar. So the math on when you're looking at the bottom chart there with the Y% and then the X days, the Y%, the actual that we've seen so far is around 20%. And the math was suggesting we should see 22%, a 22% drop. So we're within a 2% range of, and some of that could have just been where I measured it from, actually. So I think we're right there. And then the X, as far as how long that might run sideways, based on the ratio, it's saying it should be around 39 days, which takes us out to the 31st of October 2019. So,
well, that'd be awfully convenient for me because I have options that expire on the 25th. But yeah, I mean, I really like that chart that has the previous reward era and where the price is relative to where it was in previous happenings, and then like the multiplier between the two.
Yeah,
I really like that chart, and I think they're getting at some similar math between the two.
Yeah.
Here. Yeah, because I mean, like with wheat, we have seasonality, and so when you look at pricing of commodities and stuff, you'll actually pull seasonality into that. And even assets like gold that you otherwise wouldn't think have seasonality, do. And they do because of things like, Diwali and the Chinese New Year. And so, I think that Satoshi might have put this happening in order to, create this type of seasonality into Bitcoin also. Because it, all of the reasons we've mentioned. So, I actually haven't seen anybody do like a really good analysis on Bitcoin's seasonality. So there's some room for someone to write a fun article if they have more care about it a little bit more than I do.
Something on this, when you're looking at this 2020 halving cycle chart, when you look down at the bottom, I don't know if you ever used the relative strength indicator, the thing that
not really. I mean, I think I try to get the fundamentals right, and then, I do layer in some technical analysis, but I just, a lot of it's tea leaf reading, unless we find something like, a highly correlated co-integrated thing, and then it's like, now I think we have to take that seriously and figure out like why it is that way and when it's going to break or how it's going to break.
Yeah, totally agree with you. So let me just populate that one more time for people that maybe joined us a little bit later. I'm pulling up the stock to flow chart there with what Trace is referencing.
Oh yeah, and these comments on proof of keys, we're going to have a lot more fun this year than last year.
So get into it. Talk it.
Well, I mean, we're really, I really want to start beating the drum on it about the 1st of November. But, proofofkeys.com, pretty simple. We take all of our keys from any third party, all of them. Like, we just withdraw everything just to see if we can.
Yeah.
Because, you have monetary sovereignty or not. It's your asset. They're going to send it to you. So you might have to work on getting your withdrawal limits increased or things like that. And then I also had an idea today, actually, at lunch. I was messing around on my phone, and I noticed I just had a bunch of apps on it that I haven't used for a while.
Yeah.
And I was like, man, like, not only should we be going around and making sure that we don't have any Bitcoin on all of these different third parties, but it would also be a good idea just to clean up our devices, in principle of least access. Just get rid of, like, all these apps that you don't use.
Yeah.
Whether it's on your laptops or your phone, because, I mean, you don't know what those apps are doing. They might be tracking your location. They might be tracking your keystrokes. They might be doing all types of stuff that could compromise your private keys. So, I think that might be a good practice to kind of throw in with proof of keys, because it goes along with not just taking possession of all of our Bitcoins, but also just making sure that we're doing it in a safe way.
Yeah. So what would be your, because we've been going for a while, man. We've been going for an hour and 40 minutes.
Hey, I got rack up all in the morning at 5:30. I got lots of energy. I do this all night.
Dude, that went fast. Holy man. I guess my last question for you, Trace, would just be, what's something that's hot for you right now, or what's something that's got your interest that you think is worthy of discussion?
Ooh, I mean, well, we discussed these derivatives quite a bit. From what I understand, LedgerX wants to introduce the mini contract. So it would be zero point 0.01 of a Bitcoin instead of a whole Bitcoin. It would be 1/100th. So that would be a very easy way for, a lot more retail players to come in and turn their Bitcoin into a yielding asset by selling the volatility.
Yeah.
And so, I think it'd be important for people to, do some research, figure out how options work, develop some of that human capital, and, you might want to consider trading on LedgerX because I think you can take advantage of that infrastructure. I mean, it's a phenomenal tool that a hodler of last resort can use to acquire more Bitcoin.
Yeah.
And they easily passed proof of keys last year, by the way, because it was a decent sized withdrawal that I made.
that I made. Well, no, and I think that's a really good point when you're talking about proof of keys with derivative exchanges, because here we are all saying that it's vital that you have your own keys, your private keys, and if you're not aware of how ethical the exchanges that you're using, especially when you're dealing with derivatives, that's a very important consideration if you're trusting that exchange to put those Bitcoins to use or to work.
I mean, one thing that is nice about them, I got their audited financials because as a customer, I'm also a clearing member. Mm-hmm. So, the CFTC makes them give me audited financials, and the customer Bitcoins are not on their balance sheet. They're actually segregated. Wow. and kept accounted for in a footnote, which is a similar way that we accounted for people's gold when I was a gold money investor. So, there's no, LedgerX can't be lending or rehypothecating any of those Bitcoins. And every month they actually audit and make sure that the Bitcoins, on the balance sheet, match up with the Bitcoins on the blockchain. So it's nice that they send that out every month also. So, I feel somewhat comfortable letting them hold my Bitcoin, because, I feel comfortable that there's not counterparty risk, meaning the financial ability to pay. And I found them to be, competent stewards and so low performance risk. I don't think they're just going to steal the Bitcoins. You never know, right? They could get hacked or whatever, but they seem to have a very good understanding of how Bitcoin works, and the chows have been around Bitcoin for a long time, and the CFTC gives them a thorough roto-rooter on a regular basis. So other than that, I like Kraken, but man, you have to be so careful with these third parties holding your Bitcoin. Being just so skeptical about it.
I want to ask the people that are watching this live, if you've got a question, type it right now into the feed, type it up, and then Trace is going to be looking at what you guys are typing up, and he's going to try to respond to his favorite question that he sees come across the feed.
Trace. Intellectual channels, there's actually a GitHub that Chaincode Labs put up that's got a bunch of just phenomenal resources on a bunch of different topics of Bitcoin. So, I'd recommend that for intellectual channel.
All right. Well, if we don't see any questions pop up here, a lot of people just commenting, go up. Oh, IRS guidelines. So this came out today. This came out today. This was a trip. I mean, my gosh.
Yeah, could you screw it up anymore? No, I mean, it was just nonsensical. Like, they're conflating definitions of, like, airdrop and hard fork. And it was interesting. Blue Matt, Matt Corallo, he was like, I dare the IRS to come audit me.
Oh, man.
And he, yeah, so, I mean, I mean, I know people don't like paying their taxes or whatever. I mean, I don't want to look over my shoulder, and so I make a good faith effort to try and uh, pay my taxes on stuff, and I paid a lot of taxes on fork proceeds. So, you take from Jihan and you give a little bit to the U.S. government, keep the rest.
Yeah, I think that, I mean, my personal opinion on it is if you were part of a fork and you transferred those locally into a hardware wallet and you played around with those units, get ready for a statement from the IRS, especially if it was worth anything.
Well, I don't know that the IRS is going to be able to like find that very easily.
No.
I mean, they're understaffed as it is, but like an interesting part in the guidelines is like they're like, oh, if you have dominion or control over it, and it's like, well, what actually constitutes dominion and control, like over these crypto assets? Because some people might say, oh, well, if you have the private key, but I mean, you can't just go sticking your private key into anything.
Yeah.
Like, you might catch something. You might catch some type of virus. So, I mean, you have to have safe, secure wallet software.
Yeah.
And a private key.
Yeah.
And who determines whether the client is safe and secure? I mean, is the IRS going to determine that, or does the individual determine that?
And for all we know, the guidelines might have been just the sounding board. let's put this out there. Let's see what kind of reaction we have, and then let's make adjustments from the reactions, right?
Yeah, but I mean, like, they might get bipartisan. I mean, Congress seems to have pretty bipartisan support on getting rid of putting in like a $600 de minimis exclusion from tax liability. So, I mean, it's probably just some bureaucrat who didn't really understand Bitcoin that like tried to write this thing up and has really stepped in it. Yeah. And it just creates so many places where reasonable minds can differ. And I also think it doesn't follow what the law does in a lot of other cases. Like, when you have other assets to fork, and let's keep in mind, when PayPal got spun off from eBay, that's not a fork. That's a distribution, right? It's not a fork.
Yeah.
When your cow has a baby cow, or when your orange tree produces an orange, you have a fork of the cow, right? Now you got two cows. And how do we deal with recognition of income in those events? Well, you don't recognize the income when the baby cow is born. You recognize it when you sell it or trade it or gift it. Yeah. So, that's another problem I kind of see with the guidance is, I mean, it's just so different from how other forks are treated, and we have a long history of these other forks and how they've been treated, so, I mean, like the IRS agents, they want to collect as much as they can with the least amount of effort. And so the guidance, really what it does is it opens up like all these areas where reasonable minds can differ, which means potential litigation, which means it can make it a lot harder for the IRS agents. And, the IRS agents very well might lose in the cases, especially, because how we recognize income with a cow that got forked or an orange tree that got forked, why are we treating crypto assets differently? Than these other assets. like what makes crypto so special? Congress hasn't written a specific law to treat crypto differently. So they're just so. It just seems like a very odd situation. If you have recognition events, and what's really going to be the difference in price of the recognition events too? And then you've got like, I mean, it's so
It's a mess.
wild because like, okay, the fork happened, but like they're like, oh, you take the value at the time the fork happened, and you had dominion and control. Well, what if it's not trading on an exchange when that happens? And there is no market price.
Exactly.
Like, okay, so you have $0 of revenue recognition.
Yeah.
I mean, it's just, and like, what exchanges, like, what prices on exchanges do you actually trust, and how much volume needs to be there? I mean, it just seems very, it seems like it makes it more difficult than it otherwise needs to be.
Yeah, I think most people just kind of rolled their eyes today, and we'll see what else comes out, I guess.
Yeah, I try to pay my taxes,
Yeah.
fairly
No
and
doubt.
honestly. And I mean, I kind of look at this and it's like, it's not very intelligible, and it seems to be different than how the law treats other stuff. So, and and it also, doesn't, at least how I've treated it doesn't actually, it definitely wouldn't make a material difference, and it might even like be advantageous for me. Um, because you could play valuation games on the value of those forks at the time they happen, right?
Yeah.
And so you could actually like if you really were creative, you could game that in a way that you could create losses for yourself.
Yeah.
So I mean, why do you want to have that type of just craziness of where all the darts could end up, instead of just like, when you actually get it turned into like cash in your bank account, which is how most of these forks got treated. They either got turned into cash or whatever, like, and you have a nice solid recognition event that's easy to deal with and value. Then it's just not as just confounding. Yeah, Irwin Schiff, tax protester. Yeah, I don't think that's a good idea. Like, um, yeah, I mean, some people, they want to make Bitcoin their pet political soapbox, and then some people want to do that at the expense of the Bitcoin brand. Like someone like Ross Ulbricht. He's prancing around as a free market libertarian, but really what he's doing is he's trying to convert some of the Bitcoin value or brand into his own profit.
Yeah.
Not just him, but look at the whole Bitcoin Foundation founding group. Roger Ver, Charlie Shrem, Mark Karpelis, Peter Vicenis, Gavin Andreessen, like all of these guys that basically tried to convert the brand and the political capital that the Bitcoin community had created and pull it into their own private profits. And so, and then trying to like do that for prancing around in political garb, in terms of their writings or their talks or whatever. And yeah, I mean, it's just, I don't know. I don't know if that's the best route to take. I mean, yeah, don't get me wrong. Like, I think the individual needs to be empowered, and that's one of the reasons that I'm so passionate about Bitcoin is individuals get to hold their own private keys. But I'm not gonna advocate that people like take unnecessary political risk in order to and use Bitcoin as the vehicle in order to do that.
Well, you get into extremism
think,
at that point. You're just extreme at that point. You don't have a balance.
well, and then
way of
and then
thinking.
say and then say, oh, the reason I'm being persecuted is because I was pro Bitcoin. And it's like, no, the reason you're being persecuted is because you did something that was like totally illegal.
Yeah.
By running a darknet market. And that's why you're in jail for life and lost your appeal. And that's why you're going to die there. Because you're not going to get a presidential pardon because you're not going to there's not enough political brownie points to win by giving Albert a pardon. And then trying to like raise a bunch of Bitcoin donations. So like, oh, and really you were running the darknet market in order to make more profit, right? Like you took on the risk of dealing in illegal or contraband activities because there was a higher profit margin there. And the higher profit margin was there because of the potential risk of going to jail for life. And so, like, okay, now you go to jail for life. I mean, like sometimes that's just part of the value calculation that you made when you decided to run that market. So I don't think I don't think it's necessarily a very good idea to be mixing politics in your portfolio. Which we're seeing so much of. It's like, oh, we need to have green this, or we need to like, boycott Blizzard because they're not standing up to the Chinese Communist Party. Like it's, politics and portfolio like that,
Well, this is one of Ray Dalio's big things. Ray Dalio always says, you need to see the world for what it is, the reality, opposed to how you want it or wish it to be.
Oh yeah, you got to be very realistic.
Yeah, a lot of people have difficulty stepping away from how they think it should be or how they wish it would be to what it is.
Yeah, it's, I like to not be optimistic or pessimistic. I like to be realistic.
Yeah.
And, mixing politics in your portfolio, that's a
recipe for disaster.
That's a recipe to like hurt your returns. Now that's not to say that like, I just flat out won't deal or invest in particular types of businesses because they're against my politics or they're against my own moral code or fiber. But, that's just the nature of how I operate. But I see that for what it is, and I'm willing to take that cost into my portfolio. It's when you confound the two, and then you're like, oh, I got persecuted because I was using Bitcoin. It's like, no, you got persecuted because you were selling illegal drugs, and those are illegal. And like, you have to take that potential cost into account before you engage in that activity.
There's a great book called Super Forecasters. I think the author is Tetlock and somebody else, and it gets a lot into this idea of the book goes through these people that are just great at making predictions as to what's going to happen in the future. And one of the common threads that they found amongst these people that are so good at making these predictions on what's going to happen is they are almost religious in looking at both sides of an argument. So if somebody said, Bitcoin was going to be successful, that future forecaster would try to learn everything that they could about why it would be successful. Then that same person would look at the argument of why it wouldn't be successful, and they would study all of that, and then they come to an opinion based on probabilities as to how likely they think that scenario is going to be.
Yeah, I mean, Peter Thiel, he was trained as an attorney also, just like me, and I remember like my Con Law 2 class, and that's where you have all the really hot button topics in there, and we got assigned at random to either be the prosecutor, the defense, or the judges on some of these different cases in front of the whole class. And sure enough, I got the opposite. I got a case that was like a big hot button topic for me, and then I had to argue the position that's contrary to my own argument, my own feelings, right? And do that in a professional way. So, and Peter Thiel talks about steel manning the argument. Don't straw man, like what's the strongest argument somebody's got on the other side? And I think it's vital to be able to do that because, yeah, and this kind of gets a little more into philosophy and stuff, but, people just love to lie to themselves.
Oh,
People lie to themselves all the time.
no doubt.
How many hundreds of times have you lied to yourself today? And, people just don't want to see the truth, like, for whatever reason. And, man, you got people out there, they think that they can control the weather in the world, right? That, like, they think they can control the climate, and they can't even control their own mind. They are so deluded, like, just so deluded, and lying to themselves, right? And instead of focusing on themselves and focusing on what they can do to become better, instead they get totally distracted, focusing on something that they have no control over, and then they get a bunch of anxiety about it.
Tracy,
And it's just, holy cow, like, just because you're lying to yourself. And Bitcoin is the great educator, because guess what? You don't get to lie to yourself with it.
you can look at the Sharpe ratio chart and keep telling yourself that it's not real, but unfortunately, or fortunately for us, it is real.
Bitcoin is the great educator. Bitcoin is the real Bitcoin.
Hey,
you see what I'm saying? Like, it's a mirror that shows your cognitive dissonance and your biases. And what you gonna do? Gonna break your head against it? Because that's what's gonna happen. And so I think there are a lot of these people. They think that they need to, like, weave politics into their portfolios and into every aspect of their lives and their decisions, and they just get so distracted about everything, and they're lying to themselves. And Bitcoin's just not going to let you, like, play that game, because you're going to run out of economic resources if you're doing that. Because you're lying to yourself, you're going to be making bad economic calculations, and you're going to lose your capital.
So, Trace,
then what you going to do?
There's a question here that I like. The person asked, are negative rates a novelty, or have they occurred previously in history? And I think it's really important that we address the idea that, depending on what timeline you're looking at, if you go back 200, 300, 500, 1,000 years or whatever, that digital currency today, the digital dollar or whatever, in my opinion, is what has enabled a lot of this to occur. So the answer to that question is no, this has never happened before. No, we've never had contracts where one person was guaranteed to lose money that people would actually buy happen. And it's definitely something that's of the modern era today. I'm curious to hear your thoughts.
Yes, we've had a great credit expansion for like 500 years, going from gold and 100% reserves to fiat currency, fractional reserve banking. Then we had Bretton Woods. We had Nixon closing the gold window. And then we got periods of what were called negative real returns. And so negative real returns, and that's where gold really, like, powers higher, is when you have negative real returns, and that's where the interest that you're earning is lower than basically the inflation rate. But it becomes increasingly hard to calculate because of the gold price suppression scheme, manipulation of the CPI numbers, and all of that type of shenanigans that the government involved in. Because, if there's any institution that loves lying, it's the government. Government loves lying about stuff. Because it's just the nature of bureaucracy. And so, I'm not aware of, like, negative interest rates under the commodity monetary system. And since Nixon closed the gold window, no, we haven't had negative interest rates like we were talking about with the bonds, but we have had periods of negative real return.
Yeah.
And that all of this interference just makes it so much more difficult to perform the economic calculation.
Trace, I don't have anything else to cover. I was going to pull up a chart of the 10-year Treasury over the last 80 years to kind of show people the major credit cycle that's occurring, but we'll leave that for another day.
Yeah, we've had a fun time.
2 hours is plenty for people to chew on.
Yeah. I hope everybody enjoyed it.
I really appreciate you taking out time, and I know you've got many of things that you're involved in, but anytime I've asked to have a chat with you, you always make time, and I really appreciate it.
Oh, glad to do that. Oh, there's a good question from Linus. Bitcoin's behavior during a recession, is it still a safe haven? That's back to the liquidity pyramid, burrowing down into safer, more liquid assets. And during a recession, yes, you want to have liquidity because that's when you get to buy stuff cheap because, people can't cover their carrying costs, people can't make their payments. Bitcoin, gold, treasuries, like cash, that stuff performs well in the recessions and you get to buy stuff super cheap. So, we haven't ended the Great Recession, that happened in 2008. We're still in the middle of it. And Bitcoin's been performing just great, like during it. So, I think Bitcoin's going to continue performing well, especially as we have all this governmental, like, craziness happening.
I'm grabbing a book here real fast off my other shelf. If you want to learn a lot more about the credit cycles and things like that, I'd tell you this book here is hands down the best thing you can read to talk about some of those deflationary cycles that Trace was mentioning. And this book is absolutely incredible. It's actually 3 parts, where the first book, which isn't all that thick, is a template for deflationary busts and inflationary busts. The next book is detailed case studies of 3 specific points in time. The first one is the German debt crisis from 1918 through the 1924 time period. The next one's the Great Depression, and then the last one that he talks about in there is the 2007 to 2011 time period. And then another 48 case studies of deflationary and inflationary busts of large credit cycles. And so people, I think what's hard for a lot of people is what we're about to experience is something that is going to be a once in a lifetime kind of event that they've never experienced in their lives, and therefore their deduction is that something like this can't happen. But, based on a lot of historical research in a lot of different countries around the globe, you will find that it's actually quite common what's about to happen. But where it's not quite common is that I would argue it's never necessarily happened on literally a global scale. And that's where this one's a little bit different. But the characteristics are going to play out all the same. And, every one of these scenarios end with the central bank or whoever manages monetary policy within that domestic country, they have to print. That's how these end. And so I would tell people, I would buy that book. I'd read that thing. Cover to cover.
There's another good one in that vein. It's The Great Depression by Rothbard.
Yes.
But yeah, I mean, that's competitive devaluation. You already see it. Trump banging on the Fed, hey, we need to weaken the dollar. 292 megabyte block. That's pretty funny. I have no idea what's happening with BSC because I don't really care.
Hey, if you have time, this is something I'd like to hear your thoughts on. And if you have to run, man, I totally get it.
Oh, I'm just banging out these other questions. Ray Dalio, Bitcoin's a highly complex subject. He probably just hasn't devoted the time to figure it out. Securities, that's another multi-trillion-dollar question. Back to the liquidity pyramid, capital burrowing down. If we change to the risk-free asset, that's going to change the whole way that we value all of these other things.
Yep.
And so, and if companies are going to shift over to using Bitcoin as the primary medium of exchange, and they're holding that in their retained earnings and stuff, that's a huge question, for valuing companies and securities and whether you should be building your own private business or just hodling, all that type of stuff. How do I spend my day? There are tides in the affairs of men, Shakespeare said, right? So I surf the tides. What were you going to say?
So this is So I forget, this was probably like a month ago. There was somebody that conducted $1 billion transaction on the blockchain.
Yeah, how
And
cool is that?
that was awesome. And but it brought up some really interesting thought experiments for me in that clearance times. How long do we wait to statistically say that we have seen a transaction clear, right? And so when you're dealing with a transaction the size of $1 billion, based on the hash rate that existed during that transaction, the time frame was about 30 to 40 days to be able to say that absolutely, and I know you're shaking your head because that's very arguable, right? But what I think it leads to more is this idea of if you've got large blocks, Bitcoin Cash, right? How long would it take to clear a transaction of $1 billion with blocks that size based on the security of that protocol or any other protocol for that matter? And so
Yeah,
this for me is when we start getting into this being global money, okay, and the size of transactions that are going to happen amongst nations, you better there might be an argument to be made that maybe we need the block size even smaller than it is today.
oh yeah, I mean that's the Junior's argument. I think one of the greatest threats to Bitcoin is just that we lose the ethos of decentralization and running our own full nodes and stuff like that. And that's one of the reasons I started Proof of Keys. But when we're looking at like how mutable or how immutable is that transaction, it goes a lot to the decentralization, how many nodes we've got. It goes to like how costly it would be to roll back that particular transaction. I mean, after 6 transactions, I mean, stuff's pretty solid. And the protocol, with the mining reward, I think it's 100 blocks. So, after 100 blocks, that's kind of the self-reinforcing, that's the snake eating its own tail, right? So, but I mean, we just saw like a 200,000 block reorg on one of the coins, which I think was pretty funny. So, it's a lot more like what's the cost that's been sunk into equipment, like SHA-256 miners. What's how much electricity is that stuff burning down? How decentralized is that equipment? Who's the counterparty that you're dealing with? What's the potential recourse you have against them? If the transaction were to be rolled back and you weren't able to get it replayed and confirmed. So, I 30 to 40 days. I don't necessarily think that long. I mean,
Well,
so
what I was using.
you get 100 blocks. I mean, that's going to be pretty darn solid.
No, I totally agree with you. I just where the math for that is coming from. I don't know if you've read the article from Nick Carter. Nick Carter.
Yeah, I have.
He wrote just an insane article about how you get into clearance times based on the size of the block and the security of the block, and if you were going to have somebody that was going to try to reverse that transaction, the amount of hash power and all this, and what it really comes down to. And so I would highly encourage people to read the article to kind of give you an idea of where he's coming from with that. But, you look at some of these other protocols and you look at Nick Szabo and Adam Back and some of these guys from the very beginning, these guys are saying this is all about the security of the protocol. And if you don't understand what that means, well, then you need to start reading some more because you clearly don't understand what this is all about. And what they're effectively getting to is really kind of transaction clearance time. So let's say you had 500,000 bucks and you wanted to throw it on an exchange and you wanted to pull that out of Bank of America or whatever. Guess how long that's going to take you to clear that transaction into there to start playing around with that from a liquidity standpoint? Well, it's not going to be in minutes or in an hour. You're talking days. You might even be talking weeks. And so that's the thing that's going to change so much when you look at where we're at in 10 years from now when all this technology is just going to be much more commonplace. is those transaction times or those clearance times in order to conduct transactions from one exchange, one bank, one whatever to the other is just going to be like boom. It's going to happen, and it's going to happen quickly, and you're going to have liquidity. And that's the thing that I think your typical person who kind of plays around in the markets at a very low threshold level, they don't understand any of that. And I think people that are moving $1 billion, these big bond traders in the financial sector today, and they understand those clearance times, they're going to have a deep appreciation for what that technology brings.
Well, and also, when we're able to get into atomic transactions, and you can trade the bond and the Bitcoin in the same transaction.
Yeah.
Right. So the transaction is the settlement of both of the things, and they both have to happen together. And like you look at Bitcoin Gold, I think there was a $17 million replay attack on Bitcoin Gold from one of the reorgs.
Yeah.
So this stuff has hit exchanges, and you see the number of confirmations required get jacked up pretty high, because that's kind of where the sting is gonna hit. But then we have stuff like Lightning Network, and you have you don't necessarily need to have this final settlement on so many of the transactions that are going to be happening with Bitcoin.
No.
Okay, well,
that's a wrap, man. That's a wrap.
That's a wrap. I know it's late. Out where you are. Hopefully, you don't have 5:30 racquetball.
No, we're good, man. This was a lot of fun. I thoroughly enjoyed it. And maybe, in a quarter from now or whatever, maybe we can get back together and do another one.
Oh, we got proof of keys, man. We got to be talking about that. That's going to be some.
That's right.
We got to start. We got to get a betting pool on which exchange is going to fail.
Boy, it's nice to be able to take possession of that as a community, right? Because you can't do that kind of stuff right now.
Yeah, it's hard. How would you do that with gold? The refineries are already at capacity. Melting gold down to ship it to Beijing. So and we can assay 100% quantity and quality with a couple $1 transaction at the most.
And then you couldn't even prove, even if they took a picture or whatever and counted the bars, you'd have to crack them all apart. You can't do any of that stuff. Or you can't validate any of that stuff, right?
Yeah, are we gonna flex our muscles and grow a spine with our monetary sovereignty, or are we just as a community, or are we just gonna let Quadriga CX and this stuff happen? If we do it annually, we get to teach ourselves and we get to teach other people how to have this good privacy hygiene and good security hygiene with our coins. That's when you want to be practicing your emergency procedures, not when there's an actual emergency. Right?
Absolutely. All right. Well, let's go ahead and hang this one up. Trace, thank you for your time, sir. It was such a pleasure.
You're welcome. It was fun.
All right. See you, bud.